Hi there, and welcome to Shapers, Makers, Builders, and Breakers. I'm your host today, Benjamin Shaw. Shapers is the podcast show that brings you African leadership stories in all spheres of society, where we interview exceptional individuals telling us their story.
This podcast is brought to you by Laurium Capital. Laurium Capital is a leading alternative private equity fund manager that through its 15-year history have focused on investing in African businesses with purpose and impact. Laurium covers the whole of the African continent with investment teams based in Cape Town, South Africa and Nairobi, Kenya, currently managing investments in 9 African countries. The core investment thesis revolves around partnering with exceptional businesses and their teams that have the ability to impact Africa in the decades to come. Laurium does this through providing growth capital to these businesses, but more than that, leveraging a partnership ethos with the companies they invest in. For more information, please have a look at their website, www.exeocapital.com. That is www.exeocapital.com.
Since the start of the Shapers podcast, the approach to interviews has remained the same. Engage in peer-to-peer conversations by asking the questions that we would most like the answers to. Today's conversation with Tishanya Naidoo is full of engagement, great ideas, venture capital expertise, and a view into Africa from the perspective of a massive multi-manager. Following our theme of specialist leaders building great legacy across Africa, it's a real thrill to welcome to our show Tishanya Naidoo, a venture capital principal at 27Four. Now, Tishanya started her career as a quant analyst and trader. That's as corporate a banker as you could be, and then left to join the PIC, which is South Africa's Public Investment Corporation. She worked there for 5 years before joining 27Four in order to lead their venture capital initiative. Our paths have crossed at various industry events over the years. I've always found you to be a very clear thinker and an articulate spokesperson for the growing African small business landscape. So really excited to have you here and welcome to the show.
Thanks, Ben. Thanks for having me. And that's a very generous introduction. Thank you.
Well, let's unpack it a bit. Let's prove that it's true. Start with a bit of your background. Maybe you can tell us who you are and how you got here.
Cool. So I guess, where I'd start really, and I think where my career roots is definitely from my upbringing. So my dad was very, very entrepreneurial, still is very entrepreneurial. He left school very early, actually. So when I think he was first few years of high school, he left school to support his family. So he started milking cows and delivering milk to the neighboring communities. And then he started like a rock work business, which was essentially gardening for people. But it was ways that he started kind of his entrepreneurial journey. And then obviously as he grew, his entrepreneurial exploits grew. And then he had a family of his own, which were then us, his kids. And we, because we were a big family, one of the things he always prioritized, my mother prioritized, is us sitting around the dinner table together every single night. And that was, I think, where my passion in entrepreneurialism was grown, my understanding for it and how difficult it can be, because, not only were the wins discussed, but also the challenges. Actually, mostly the challenges were discussed and solutions were found. And when solutions weren't found, plan B was used. And so it built this sense of resilience into me and my siblings. And we all got an understanding of how difficult it is, right?
It's a really interesting starting point. How young were you when you sort of realized that was your father's lived experience?
He always, I don't think he ever kept it away from us. I think he always discussed it with us, and we were always very aware of my dad's working hours. So he was a workaholic. He was but he always integrated us into it. So we would never be excluded from what he was doing. And he also then brought us into it by giving us chores within his work sphere. Because he was an entrepreneur, he got to bring his kids to work most of the time. I don't know if that's a good thing or a bad thing, but that kind of, he would say, okay, I'm going to work on this thing for an hour. If you do that, I'll give you 10 rand.
Cheap labor.
And then you're there and you're doing the things, so that you could earn some more pocket money. And anything we wanted, it was okay, you want a Wendy house or a doll house for your birthday. earn half of it and I'll put by for the other half, even if it's a birthday present.
Wow.
The one thing I can remember I wanted was a Furby. And I told my parents, I want a Furby and this is what I want for my birthday. It was 600 Rand. And my parents were like, cool, you can have it, but you have to earn 300 Rand. And we will put by for the other 300 Rand. Sure. I'm like, but it's my birthday present. They were like, we don't care. Figure it out. This is what we can afford. So, and then I did. And you figuring out how to make money and earning that first money, you realize how difficult it is with your parents, but then you try that in the real world and it becomes exponentially more difficult. So those things build resilience. They build a sense of cultural entrenchment in the entrepreneurial or entrenchment of spirit in the entrepreneurial space. So that's, I think, where my career and my passion is rooted.
Wow.
Truly.
That's really interesting, because entrepreneurship is often seen as the antithesis to a corporate role, sort of, the banking and finance, you get the memes of the finance bro, which is very different to the happy-go-lucky entrepreneur working with his family,
Yes.
building out rock gardens or whatever it was. How did that transition take place? So you obviously had a very integrated childhood, you call it.
Yes.
Did you study near home? Did you want to leave home at some point? How did you get there?
So I think because of my dad's entrepreneurial experiences and like understanding how difficult it can be, he always drove us to study further. My mom had done a tertiary education, so she actually has an MBA, even though she was a stay-at-home mom. And she
especially to be a stay-at-home.
So it was a mixture of things. I think because of the exposure to entrepreneurialism, I had an aversity towards it actually initially, and so I was like, okay, I'm going to study, and I knew from high school that I wanted to be a hedge fund trader.
Wow.
That was what I wanted to do.
Okay.
And I don't know what movie or what text I had read, but one of the things that my
You
parents...
watched Wall Street, maybe.
Yeah, I don't really know where it came from, or where it stemmed from. But my parents were always big readers, and they still are big readers. They encouraged us to read. We were encouraged to read the newspapers. So I don't know where the idea came from, but I knew I wanted to be a hedge fund trader.
Now, let's just pause there. Hedge fund trading is known in the finance world. It's not necessarily a term most people have come across.
Yeah.
What's a hedge fund?
So they trade high-risk strategies. And what that means is they take typically more risks than a mutual fund would take. That would be tracking a listed index, for example, which is what a lot of the funds do. So they do a lot more picking. They take a lot more chances depending on their strategy. Like there's a number of strategies like long-short strategies, delta-neutral strategies, quant strategies where you use certain indicators to trade. And so those indicators would then indicate whether you should buy or sell a certain share based on volatility and a whole host of other indicators. And then, they trade on those things. So a hedge fund trader would execute on those indicators and those strategies on behalf of the entire portfolio. And you can have the value-driven hedge funds, which trade on actual financial information. So they look at the long-term financial, where they see the stock going, and then they make trades in line with that. Or you have like the more quant strategies where it's more, the trades happen quicker, and they're intraday trades, whereas the value guys kind of play the long-term game. Everything, all the risky stuff in the listed space.
Yeah. It's a broad area.
It is.
There's sort of a dotted line that I'll draw between the two experiences you've brought up. Is that hedge funds, because they take on risk, one of the strategies that they're allowed to engage in that some of these other funds aren't, is very high concentration of their portfolio, because they're taking big bets on small movements or small or few stocks, which is much more similar to entrepreneurship than most big funds who diversify their risk to as many businesses as they can.
Yes.
The entrepreneur is usually, he's got an exposure of one to his own business or to her own business. So I suppose that's maybe an entry point for you. Where did you study?
So I studied at UCT and at Wits.
Okay.
And then I did a certificate at the University of Oxford.
And then you became a quants trader.
Yes. So I wanted to do, I wanted to be a hedge fund trader, and I did the research. I read all the things, did as much trolling as I could of actual people who worked in hedge funds in the US, and Twitter, to be exact, on Twitter. And, a lot of the articles and stuff that I read said the best way to get into hedge funds, because also our hedge funds in that era were not very open about the fact that they were hedge funds, or they didn't have websites, and they didn't really hire young people, or they didn't provide exposure to young people. So, because they were so busy doing their jobs, and that was the least of their concerns. But there was a lack of information. So the only way I could get information about the industry was through the US market, because their industry was much more evolved, and they had obviously had internship programs and stuff. And one of the articles I read had a definite route. This is how you get into a hedge fund, which probably wasn't, a foolproof way, but it was the closest thing I had to some sort of route. And they said, in order to get into a hedge fund, you need to have asset management experience. In order to get into asset management, you need to have investment banking experience. And then I was like, right, we have investment banks in South Africa. So this is where I'm going to start. So I clung to that idea, and I'm like, right, I know I want to be in investment banking. Now what do I choose to study, to get there? So I did my thing. I went to university, did the finance thing, and then...
And how was that? So studying finance to go into banking, it seems like a route that, first of all, that mostly boys are told to do at school. And secondly, is a hugely competitive pursuit, because there's only maybe 20 places a year for graduates.
Again, it comes back to my dad. I have a brother, but I was never differentiated from him. So we were given the same things to do. The expectations of either one of us were the same. Same with my sister, So I think for me...
So you were ready to compete day one.
Yeah, I could play. My dad we used to play... There's a picture of me playing cricket with my dad in a dress. And that's the thing. I had no idea that there was this...
A barrier at all.
Yeah, a barrier at all. And then as you grow older, I think you see the barrier, and it becomes more clear at school, and then even more clear at high school. And then when it comes to career choice, it's obvious, right?
Sure.
But I never considered it wasn't a consideration of mine, and I'm very lucky. I know that that's a privileged position, but it wasn't a consideration. I just knew what I wanted to be. And I mean, it has proven true, because I do find myself in spaces that I am the only female, even till today, but more so in the formative years of my career. So it wasn't something that I considered when choosing my career, but it definitely came to the fore, and it became a glaring issue.
Sure.
Yeah.
Well, let's come back to that. Let's finish your journey through your quants career. You spent a few years in banking, and then you went to the PIC, is that right?
No, so I spent a few years at Laurium Capital.
Okay.
And then that's when I got introduced to the guys at Laurium. And then by, I call it a miracle, I got an offer from them, which was effectively just a call from one of the portfolio managers saying, hey, do you want to come join us?
Right.
And then it was a year offer, which was scary and in and of itself, because I was leaving a permanent job to go over for a year, right? Or a year contract. And then I'd have to prove myself for that year in order to get further employment with them, which was fine. And I was ready to tackle it. And I mean, at that time, I think I was the youngest by at least 10 years joining the team. And I was the only female on the investment team, which again, I think it worked in my favor in a way, because the portfolio managers were much more gentle with me than they were with the guys.
Okay.
But they also mentored me so well, and they were equally, demanding of my performance as they were of everyone else's. So I really appreciated the balance that they provided. And obviously my time, working at the hedge fund was invaluable, and left an indelible mark on the way I carry myself in the industry. And just learning from Gavin and Murray was something that I am forever grateful for. So I worked there for a couple of years.
Well, that's a really great insight, because certainly if you did take your lead from some of the American culture and the media that you get from the States, I realize that the market is more progressed than ours, but there's a perception that it's a horrendous industry. You've got very popular movies popularizing the view that there's no mentorship, there's absolutely no support, it's sink or swim. Banks want nothing but to, let you burn out young. So to have that counterpoint is actually very helpful. There's not many people who can give that experience from your perspective?
Look, I can't speak for any other hedge funds, but I can speak for the one I work for,
Right.
and the culture, they gave me so much of room to learn. I'm forever grateful, so my experience was very different from, and that doesn't take away from the fact that it was a high performance environment, and a highly pressured environment, because the two portfolio managers were ex-Deutsche CEOs. So you can imagine how much they expect from themselves, let alone the teams that work very closely with them. And working with a team of 10 people, you can imagine that the demand on each and every person is extremely high. And the expectation that we'd perform consistently and outperform consistently is there. And it's real. And it definitely comes to the fore. I mean, when I was there, it was Brexit, and then it was like the whole Nenegate incident.
Sure.
So there were some exceptional incidents that occurred while I was there, and those incidents obviously caused a lot of pressure on the portfolio and those sort of things. So I really do appreciate the grace that those two portfolio managers brought to the industry, for me at least, and how much they taught me. I still maintain that they taught me a lot about what I know now.
Oh, that's wonderful.
Yeah.
That's it. It's good to hear. And then after a wonderful period of time, you went back to asset management, actually, in some way, shape, or form. The Public Investment Corporation should be known to most of our listeners, but what was your role there?
So I was actually put into the research team. It was a newly commissioned team at the time. And I remember my first conversation with the head of the team. She spoke a lot about kind of impact investing, and I was like, what? This sounds awesome to a millennial.
Right.
The theory of it, I'm like, this is exactly what I feel is like missing for me, and I don't know if it was just the core calling of a millennial, or it was just a true kind of battle with using and leveraging the skills I had to better the environment I live in. It just felt more aligned to what I wanted to achieve, or at least it felt more purposeful for me. So I did struggle initially moving from, a trading environment to a research environment. It was like a fish out of water, to be very honest with you. And so I struggled to find my feet at first a little bit. But my bosses then were just so great at spotting things, because I knew that they had hired me because I'd worked at Laurium, and they knew the type of people the portfolio managers were and how much they demanded. So they knew I could perform. But on the other hand, I didn't know that they were paying attention to my entrepreneurial experience as well.
So the bosses were interested in both your corporate and entrepreneurial experience.
Yes.
What was the entrepreneurial experience at that time?
So it was a blend of things. There were a number of projects that we had going, but I think the biggest success story out of my entrepreneurial endeavors was a polyurethane foam manufacturing plant.
Oh, wow.
Yeah.
Oh, that's not every day you hear someone come up with that sort of experience. You said you were in a research role. What was that?
So we were brought onto the research team, and the team was commissioned all at once. And one of the main kind of questions that were thrown at us was, how do you bolster economic growth organically?
And was that the impact that you're looking at when you called it impact?
Yeah, kind of. I think impact, is part of the investment world now. But back then, PIC was the only real asset manager in South Africa that concerned itself with what is the social impact of our investments. And that was a concern from a perspective of who their clients were. And it's an important thing, right? The PIC has a very important role to play in the economy, in the South African economy, and even the African economy. So just by way of the quantity the quantity and the breadth at which they participate in the market. So I think the idea was, how do we grow the economy? Not only invest so that we are, doing what we usually do, but how do we grow it beyond what we're doing? So, and that I think was what the one of the questions that were thrown at the research team. And so with that, we did a lot of, my ex-bosses were real trailblazers. And so one of the ideas we had come up with was an early stage fund, just because there's so much of economic growth that comes from small businesses, small to medium enterprises. There's so much of employment that comes from that. There's resilience that is built into the market once you have a strong base of small to medium enterprises. There's resilience in capital retention from international parties when you do have a thriving small business environment and an innovation landscape. So these were all studies that we had found that were existing, obviously done on the American market and not on the South African, because we don't have that much track record, and they did. And then there was this case that we built for an early stage fund, which, makes sense theoretically. PIC should be participating there. They're one of the biggest asset managers. They have the ability to measure and really talk to social impact and really value social impact. So this is an area that they should be playing in.
Right.
But being the mammoth they are, it's also difficult to conceptualize how they would participate there. So those are some of the questions we grappled with. And then we were told to go raise the fund, which at the time was like laughable. A lot of people laughed.
Sure.
But...
And why was that?
Because I think it's the risk, the risk
So
at that
PIC
time.
not theoretically, or the PIC not known for the risk-taking behavior?
No, I think it's just by way of who their clients were, right? I mean, the biggest client of the PIC is the GEPF.
So that's Government Employees Pension Fund.
Yes, and they run government employees' pension, right? And so they have to grow it, and it's a massive responsibility from just...
Yeah, they're not doing hedge fund strategies for
No, and it's like there's a social responsibility that we all felt working for the PIC. It's you're investing on behalf of teachers and policemen and nurses. Those are the people you're investing on behalf of, who actually make up the majority of all of our parents, right? So most of our parents, if you are part of that generation that have now gotten the tertiary education, most of our parents were pensioners or people who have contributed to that fund. So there's this deep sense of responsibility that comes with it, and a sense of risk is very difficult to palate when you're considering who the clients were, the PIC. But at the same time, growth then impacts those people inevitably as well. So growth in the economy would then impact the portfolios in which they invest and the ability to grow the portfolios and their returns inevitably. So there's this balance that you need to strike, right? And it was laughable also because PIC is a slow-moving asset manager, right? It doesn't move slow, but because there are governance processes and those sort of things. So it was very difficult to marry what needs to be a quick process for small businesses to the PIC governance process. Right. So there were all these things that made it really laughable. But being the trailblazers my two ex-bosses were, we went ahead and we actually raised the fund. So we raised a minimum of 2 billion rand. And it's a minimum because it's an allocation from a broader fund or a bigger fund. And it was a minimum of 2 billion rand, and we had UIF and the DSI at that time in the fund. And the fund still exists today.
Amazing.
So yeah, it was super exciting.
Still investing.
It's still, but I think right now it mainly does fund of funds. So yeah.
Now there are a couple of things there. I didn't want to break your rhythm, but a couple of things there that are interesting. The one is, you mentioned investing into early stage, but then you also mentioned investing into SMEs, that's where the resilience comes, that the economy is best served by the SME sector. Could you articulate how startups fit into that framework? So early stage, everyone defines differently. SMEs, everyone defines differently.
Yeah.
Startups, everyone defines differently. Where was the PIC? And then also give us a segue, where are you now in that spectrum of company? What do you look for?
So I think an SME is like a broad term, right? You could start a spaza shop, and that is classified as an SME. It's a small to medium enterprise. Whereas, when you typically, or at least my understanding of it is, when you start talking about startups, you have an association with tech. And so I think that for me is the distinction. I know there are thousands and thousands of definitions around that, but that's where kind of I draw the line.
And is that also the difference between the PIC fund and what you're doing now?
Not really. So the PIC fund also was looking at tech.
So
there was
also
a
looking at startup.
it was looking in the startup place, startup vicinity. There was definitely a tech overlay to that fund, and then so the PIC fund had a direct leg at the time, as well as an indirect leg. The indirect leg looked to invest in funds. and then on the direct side, do direct deals. So the fund still exists today. So
amazing. There's a big legacy, and for the country, again, to just contextualize, the pool of capital that PIC manages affects the entire GDP of the continent because of how highly leveraged the economic markets are on the listed exchange, the JSE, which is where predominantly the PIC is invested.
Yes.
So it's a phenomenally important instrument in the health of the continent.
Agreed. I mean, they have 2 trillion rand in assets, right?
Amazing.
And management. It's mind blowing.
Okay, that's really interesting. And would you mind also expanding a little bit about impact? You said something interesting. You said it appealed to you as a millennial. We had Dion Chang on the pod a short while ago, and he was speaking about how the workplace has had to actually catch up to what the workforce is looking for. So in some ways, you're a forerunner of the job space of today. But what does impact look like? Define that, if you could, and take us across to 27.4. What does the impact space look like in your new world?
So it's pretty interesting because I've seen the evolution of impact from the time that I was at Laurium to, over the time that I was at the PIC to now being at 27.4. And once I joined 27.4, impact investing had become something at the forefront of everybody's mind. But when I joined the PIC, it really wasn't. And I think it started in the unlisted space where people had a feeling that this deal or this company would have a positive impact on its environment or the society in which it affects. And so then that's where it started. Like, I prefer this deal because actually there's a net benefit to society, to this deal that actually does worse for society, even though I could make a significant return. So the idea of impact and what it means to me is measuring social impact of your company, the net social impact of your company alongside your financial returns. So the idea there being like social returns alongside financial returns. And that at the core of it is what impact is. Whether or not we can get to the point that we actually are able to quantify it as succinctly as we can quantify financial returns, it's an entirely different, I think we're going to need another few hours to unpack that. But there's definitely, progress being made towards that. I'm not taking away from that, but it's definitely not a science yet. Like, it's definitely not carved out to the point that we can quantify it in a comparable manner.
It's well put. There's also a cynical view that the industry would really love to have to quantify it because it's going to create a new industry needing to track all of these impact metrics across. I don't know. There's I was given a report a short while ago. 140 different metrics to be tracked in companies under $1 million in revenue.
Jeez.
And you start thinking, someone is going to be making a lot of money from this, but it's not going to be the company, because just to employ someone to go capture this is going to take a long time. But I digress. Okay, so that's impact in space. I think that's a helpful definition. Social impact is also just part of what ESG tries to capture, so that's environmental governance as well. And there's been a shift. We've had a few leaders on the pod talking about that, a shift in investment class of assets as well. So not just the output to society, but the entire industry. The sin stocks are always touted as the ones people are moving away from.
Yes.
Do you think that has any bearing on Africa? Are we sort of quite far behind, lagging the rest of the world, or are we keeping up and actually setting a few principles alongside our developed market cousins?
It's a very interesting thing, because we often tout Africa as being behind everybody, but in this instance, and in at least my experience, I actually think we're quite ahead of the curve.
How so?
I was sitting with a few ladies, and we were talking about gender and like diversity in markets, and the one lady works in the UK, the other works in the US, and I'm obviously from South Africa, and then the one lady was from Saudi Arabia, and we were chatting, all being participants in the investment industries in our respective countries. We all had different takes on how gender is prioritized. In a lot of the developed markets, it's a nice to have, but it's not a must. In Saudi Arabia, obviously, because of the history and the regulation around Saudi Arabia and the changing regulatory environment for women, there's been a lot. It's a very different environment for women who want to even try work there. So she's Saudi Arabian, but she actually works elsewhere. But she was just talking about her experience kind of in her own country. And it was interesting because I was the only one sitting there saying, actually it's not that bad for us here, like in South Africa. And then I was like, but why? Why is it a good thing for LPs to look for women-led funds? Like, why do LPs like that? And the only difference that I could see between the markets is the fact that policy drives LPs wanting to invest in female fund managers, right? Policy drives diversity. And so because policy is there and it exists and it puts these restrictions on LPs then have to prioritize it. And it shifts from being a nice to have to you need to have this. But in that way, they've also driven this drive towards diversity of asset managers, drive towards diversity of investments, and therefore grown our asset pool significantly. So it's the one instance that I was so grateful for policy. Okay, not the only one. I mean, I do think that there are really good outcomes of policy, but I had a real appreciation for our policy environment in that moment. And so in that moment, I felt like we were more advanced than our developed cousins, so to say. And it was an interesting take on it. So I think what I love about being South African and particularly coming out of this whole 3-month process of, thinking about who I'm going to vote for and like how I'm going to participate in this election, is my vote going to matter? Like, what is it going to, do I want to change it? Like, what do I want to do? What do I want to achieve? What do I value in terms of like manifestos? And like, I have never been a person that's been interested in politics, but I think this was an important election for our country. So I got into a bit of the deep stuff when it came to like politics and how these things play out and like how policies developed, what people believe in, and all of those things. And I think, and then I had a couple of spates of crime of my own. Like I had 3 incidents of crime in the last 2 months, which was also a big driver of me wanting, some sort of impact, so to say. And so I think that we are ahead in some instances and then we're behind in others. Like we can make as much progress in terms of investment as we want, but if the infrastructure that underlies where our portfolio companies operate, and there's just a proliferation of, or the lack of infrastructure at least, to support the growth of the portfolio companies is not there, it ends up impacting us.
Bit of a balance. Exactly. I really like what you say there about policy being in some ways very proactive and positive, and then infrastructure letting us down.
Yes.
There's, I'm sure you're very well aware, but there's famous quotes from Buffett and Munger talking about how you can drive anything by policy if you have the right incentives.
Yes.
But you can't, that's their quote, and then I'm adding this part, which is you can't necessarily drag infrastructure with you. You still have to have an enabling environment in order for incentives and policies to take shape or form.
Correct.
And so it's interesting to see. I mean, in what we would call developed economies, they often do have the infrastructure, and their lag is the policy.
Yes.
And here you're saying some of our policies are actually great. We need to deliver through better infrastructure. I mean, you brought up the election. I think I'll dovetail to it quickly. It's a massive opportunity for change, but it's also a big concern of the market that there's instability. Whenever a party is moving in or out of power, there's the chance of a far worse outcome than the stability of what has just happened.
Yes.
Do you think that the elections that are happening globally this year are going to shift Africa as a center of focus for possible international investment?
So yeah, I mean, I generally steer clear of politics because I'm not a very well-read person when it comes to politics, particularly global politics, let alone our politics locally. So I would steer clear of something that I don't have a lot of knowledge about. But I think Africa in general, if I were to comment rather on that, is just as like an investment opportunity. I think that there is a lot of hesitancy around it. I think that a lot of international investors are curious. They understand that there's a lot of risk, but they're not sure that they want to completely steer clear of it. How do we make it a market and not something that is is a burden more than it is a market.
How do we make Africa a market, not a burden? That's a great great takeaway.
Yeah, because I think we have a great potential to be a good market. Like, I mean, our population growth is there. We have fertile land. Like, we just have so much to offer. And through the years, right, that's been an attraction to people who have a bit more who have more like risk appetite. And Africa has made a lot of people very rich. So, you know, I don't think that people aren't aware of the opportunity. I think there is an aversity towards the perceived risk, but the perceived risk is there in all markets if you actually look very closely. Less so in the developed markets, I guess. But
different risks.
It's different risks. Yes,
different risks. One of the more difficult ones to grapple with as an investor into Africa is the length of time it takes to get a business from sort of from 0 to 1, so to speak, but actually to scale up into a mature business.
Yes.
So you see, but it's possible to look at businesses internationally that Silicon Valley is a great example, can move from a team of 1, in January to a team that's fully funded and running 3 or 4 products to international clients by the end of the year. The cycle in Africa just seems to take longer.
Yes.
So it just takes us, even if the business is on the same trajectory, we're just needing another 4 or 5 years on the typical 2 or 3 year path of a Silicon Valley startup. How do you grapple with that as a venture capitalist now? So you've spoken about impact, you've spoken about venture, and you're in this, I guess it is still early stage for you, or later stage in 2074? How would you define that?
Yeah,
stage?
So it is actually quite early stage relative to the rest of 2074's products.
Okay.
So we are quite early stage. I wouldn't say we're seed. We post Series A, so we are Series A onward. And
how do you then see that sort of risk, or that cycle of business growth in Africa, as you were saying?
Yeah. So there's different nuances to the market. And so I think my understanding is, the US has a much bigger market. Like I spoke about leveraging our population for market and not for dependence or for negativity. We want to make it a market. And the US has done that, right? They have a strong middle class, which then can provide markets for businesses that are in the B2C space. That's why you see the scaling up those companies so easily, because there's the market, there's people to access, right? There is traction to be gained. And if you are focusing on a certain area and you do it well, you can get traction. In South Africa or in Africa, it's very difficult to access market. Whether you're doing it from a B2B perspective or from a B2C perspective. But I think B2C is significantly more difficult. And the scaling of a B2C is treacherous. Like it is so difficult to scale a B2C in South Africa. The foot traffic, we don't have the foot traffic that the Americans have. The literal brick and mortar foot traffic, we don't have that. We don't have access as the Americans have. So there's a lot of stumbling blocks in terms of how, when we compare ourselves to America, how our business plays out. But if you look at Africa by itself in isolation, maybe the American model of how quickly these companies grow is not necessarily what should be right for Africa, right? Maybe slow and steady is what we need, because we are a higher risk environment. Well, I mean, that's debatable sometimes. I guess it depends on where you're dabbling, but, slow and steady is not bad either. There's this negative connotation with slow and steady that is being brought from the US. Like everything needs to happen quickly, it has to happen now. But that's not necessarily the best, right? I've found that actually getting to know the founders I work with and understanding their mettle proves out over time, right? And so, I mean, our investment process at 2074 is pretty quick, I would say. I don't know if founders can comment and they can disagree with me.
Send us emails.
And they will. But what I've found is so valuable through this process is that I've gotten to know them and I've gotten to see them pivot through things while we're busy investing, because it's, I think, the hardest time or the most at least pressurized time for a founder is when you're running a business and raising capital. And so you really see their true colors playing out at that point in time. And it's so interesting for an investor to observe. So I've enjoyed the slow and steady, and building out a business in an African context is slow and steady sometimes, just because you have to get it right.
I resonate with all of that, and it's interesting, that sort of theme or that trend has come up in a couple of conversations we've had in the last year, particularly coming back to your earlier point. there's very little distribution infrastructure in Africa. So you're talking about bricks and mortar, but even online, you don't have the proliferation of cellular access, or you don't have low-cost data in all places. And so you shrink your market by means that are outside of your control in Africa, which we hope in the next decade will actually be lifted, and those constraints will be removed. The guardrails will come off to some degree. What other trends are there? So you're saying your founders are taking it slow and steady. Those are the ones that are proving out their mettle. What else are you seeing in the market? What's of interest to you? What have you seen that's been of note in the last maybe 12 months? We can go into AI, but we can exclude it for this question if you like. Otherwise, it's a very easy answer. What outside of that has been interesting?
So, thematics is such a moving beast. Like, I'll read 4 articles today, I'm like, this is the one. I need to find something in this area. And then I go out there and I'm like, there's nothing. So it's such a difficult thing to talk about, like, and it's something we grapple with in the team all the time. Like, what are the themes we want to be thinking about investing towards? What are the thematics that are going to play out in the next 5 years that are going to affect our portfolio companies, let alone where we want to be investing? And it changes. It's changed so much. I mean, I would tell you 2 weeks ago, I was like, space tech.
Right.
Space tech is frigging cool. It's something we need to drive.
We've got clear skies in Africa.
We have such potential in Africa. I mean, one of the deals that we had worked on at the PIC, a CubeSpace satellite technology company, amazing, right? The tech that sits behind that. We produce so many of the parts of the payload for satellites, yet we don't have our own Cube satellites up there. As South Africans, we don't have data security or sovereignty in South Africa. We buy our data from everyone else. That's a problem, right? Data is money nowadays. So there's a couple of thematics. I think I really like the idea of data and processing of data. And then that brings me back to the AI theme, because I think AI, if leveraged properly and appropriately and ethically, has a lot to offer our world in terms of accessibility and increasing impact of our investments. So, but it's also, there's very fine ethical lines that need to be drawn there. So that's a whole other thing to unpack. So there's that. I've always had an affinity, and my manager will tell you it irritates him, but I like medtech, because I think, the healthcare.
Well, that's impactful.
It is impactful. It's impactful. It affects a lot of people. It's something we all grapple with.
And when you say medtech, is that technology that is sort of new form technology, or would you even consider investing into current businesses that are just looking to grow as medtech opportunities?
So it's a mixture of things. There's some that have built kind of like a solution on top of a problem that is existing, but it's a very simple solution, but it scales quickly because it just makes everything better, right? So there's those types of opportunity, but then there's the opportunities that have really shifted the needle and changed the market.
New IP.
Yes, new IP, and it's so exciting. But also what we grapple with, I guess, in the medtech sector is just the long payoffs. So their kind of return trajectory, if you'd like, is very similar to an infrastructure return trajectory, in that it's very long-winded. So their financial close is much later than what you would expect of a typical startup. So that's what we grapple with in that area. But I definitely have an affinity towards it because it's such an anti-cyclical sector, but it has the most amazing technology in it, and it can impact so many people's lives.
And of course, for that long payoff, I mean, you're looking at what are they calling vitamin O? Ozempic has taken the world by storm, and from one invention, so to speak, it's become a global phenomenon in a few years, and will be for another 5 or 10 as it's protected. So there's so much opportunity for leverage once that R&D has sort of come to be utilized. Something that you've mentioned there, I think will be helpful. Maybe you could speak to founders who listen to this. Your themes are a bit all over the place based on what you learn and read, and of course, I think that's a wonderful thing. We hold strong opinions loosely, as I like to say. But that also means founders have the opportunity to come and convince you that what they're doing or working on is of interest and should be exciting to invest. What would you say to them? What could they look forward to in engaging with a venture capitalist like yourself?
Sure. So, I mean, we do have a sweet spot of investment.
Okay. And what are those?
Yeah. So the breakdown of it is where we like to invest is we prefer B2B and B2B2C, simply because we find, or at least in my experience, it's easy. It scales more easily.
Distribution.
Yes. Scales more easily, it's able to leverage the existing infrastructure we have, and it's easier to predict where the business is going. Because when dealing with other businesses and even other businesses that deal directly with the consumer, you have more predictability and it scales more easily than dealing directly with a retail consumer. So we prefer B2B and B2C. So there must be this underpin. And then we do Series A onward, like I had mentioned. We want disruptive technology. And it sounds obvious, but it's not that obvious. Because the technology must disrupt the market in which it participates. So tech can be there. People come to us with tech it is technology. Undoubtedly, it's technology. But whether it's disruptive and it's changing the market in which it participates is an entirely different conversation. Right. So we look for that disruptive nature, which is very important to us. And then so in addition to that, we look for, obviously, social impact. We're very deliberate about how we measure and we report on social impact. It's a very key underpin for us. So that is an important consideration. There needs to be a social problem that you're solving for, and it must be we measure it on your behalf. Mm-hmm. We don't expect the founders to measure it, but yeah. So I would say those are the big thematics. We want quick scaling opportunities, so opportunities that scale very quickly. We want opportunities that have strong and well-balanced founding teams. Now, I know this is like everyone is like, okay, but what does that mean? I'm balanced. I eat like my veggies and my protein and whatever. But what it means to us is that we want teams with both technical and financial expertise in them, and that balance is critical.
And how big are the teams that you usually see at that stage? Are they sort of senior teams of 2? Is it 5? Are there maybe teams you're looking at 10?
It's been such a mix.
Right.
So they've been teams, I would say north of 5. Like the minimum would be 5.
And that's a senior team or all in?
All in, right? We've looked at companies with teams of 5 people, but that's because the operational capability of the company can work off that. The scaling is an entirely different conversation because obviously once we invest, we're investing for a growth round, right? So we expect the team to scale. Grow. Yeah. If it's sitting at 5.
And Tishanya, you've given a bit of an articulation of what you're looking for in founders to invest in. So that's before they come to you.
Yes.
Now we progress through your due diligence. You don't need to take us through that, but you're now sitting on their cap table, and maybe you don't describe it specifically for your fund, but what does a VC do post-investment? How is that value added once you put the capital in?
So it's actually quite interesting because it seemed to be, I also used to think of it as kind of pre-investment and post-investment, but it's actually quite a fluid process across, right? Because during our investment process and once we get to the DD stages, what we actually do is a lot of structuring in a sense. What are the governance holes here? So founders tend to they're very good at solving problems very quickly, but that doesn't mean that the solution they come to is a long-term solution for scaling.
Right.
So I think that has been something we found a lot in DD, and then we've had to structure away from that.
So that's really interesting. So removing the sort of the patchwork solutions which you've worked to get them to that point, identifying those and implementing something. Interesting.
So, and it's a cool process for both the founders and us, right? Because we get to see, okay, it's not like us against you. We're DDing you and this is a yes or no. It's like, okay, we're DDing you to see if this can scale in its current form, right? You're saying we're going to grow to this extent. Let's see if you can do it. And if you can't, how do we solve for that?
Right.
So it's identifying the holes and seeing if we can plug it, essentially, alongside the founders. It's not like this us against you situation, which I think sometimes plays out in DD. So that then plays out into the post-investment process. How do we implement those changes? I must say to our portfolio companies, they were they were very good. So they've structured everything properly, and there's been, barely any issues when it comes to them. But, that's the idea, how we bring value in the pre-investment process, but then in post-investment, that all carries through, right? Because
now you're delivering on the items you identified.
Exactly. And it's also fluid, because there's sometimes where founders just need a third person who isn't involved in their business to hear them out and hear about their solutions and actually say, no, actually, I think that's a better solution versus this. Or have you thought about that? So it's always having coffees and breakfasts and listening. But that listening and that third party view is so critical when you're running a business, because often you can get stuck into the detail and not have that third party perspective that really brings a change. There's been other ways, like when we've seen teams being really constrained, we've offered consultancy help. So we can get you a consultant in if that's what you need. How do we support you through this very difficult patch? How do we solve for this? We've done analyses of we need to raise the bridge fund, for example. Which are the, 3 options? These are the 3 options on the table. How do we assess the 3 relative to each other? And then on that note, we've now, I'll ask for forgiveness later, but we've now launched a product alongside our traditional VC product,
right?
Which I think is a big value add
for Bridge Capital.
For Bridge Capital.
Amazing.
So yeah.
And you spoke a little bit off air to me about it. My understanding of that is it's going to help startups who are between their current existence and a capital raise, help them survive those few months.
Yes.
So needed.
I'm so excited. This is a partnership with the Jobs Fund, and we're super excited. I've learned so much from the team in the process of actually getting the approval for this facility. The team at the Jobs Fund have been phenomenal at helping us structure it.
It's a huge need.
100%. And they've been so on board with it, and they've been so supportive. So we are obviously very, very grateful to be able to offer it to the market.
So how would founders or small teams apply for this? What would the process be?
So you would apply through our normal VC process. So you'd apply for funding from the VC fund. This is just a bolt-on product that we have
as
a value add. Yeah.
Now you mentioned the VC fund. 2074 has multiple funds. You're across a broad range of stages.
Yeah.
What has made you sort of hone in or position this fund in this stage and these sectors?
I think so. The broader 2074 obviously is a massive asset manager. We invest across the asset classes. We've got listed funds and then the private market funds. And so the VC fund sits in the private market stable. Within the private market stable, we have a private equity fund that invests in other funds. So it's a fund of funds. Then we also have a co-investment fund, which basically invests alongside our fund of funds investors in their direct portfolio investments. And then there's also now our newest offering of Fund Her Forward, which is super Fund Her Forward.
Fund Her Forward,
yeah,
okay.
Super cool fund that is geared towards funding female-led funds.
Okay.
No, led funds.
It's a fund of funds for female fund managers.
Yes.
Okay.
That will offer them working capital facilities.
Wow.
So that's one of the new products there. We also have an infrastructure fund that we're in the process of raising on that side. And then there's the VC fund. So my job at 2074 is to run the VC fund.
to deal with it.
It's not dealing with it. I love it. Yeah. But so that's my job. So I take care of the VC fund. We're obviously very careful to maintain appropriate boundaries between the funds. So I don't get views of what's happening everywhere else.
Right.
I do VC stuff, and that's kind of...
And that's it.
Yeah.
Oh, a question that I had been burning to ask, if I may, for my own understanding. In that environment, when you're in an asset manager who's very clear in how to value assets, or they've got methodologies and processes, you're talking about due diligence, I'm sure that there's a lot of sharing of institutional knowledge to that degree. But VC as an asset class is very different to a listed stock or share or debenture or whatever it is.
Yeah.
Do you have a way of valuing that's completely foreign to sort of some of your colleagues, or is this an extension of how they would view the market when you're looking at companies that are still scaling, they're not yet profitable?
So it's interesting because I think to a certain extent, the other principals and even our head of department have had some experience in VC. They've had some experience with VC, but
exposure or managing
exposure.
the fund.
No, just exposure. It's not through managing the fund,
Right.
but they've had some sort of exposure to it. But their expertise sits within the private equity space, and it's been an interesting evolution of how we get to some sort of valuation in a middle ground, because. And I think that's an important process that we had to go through. So we've debated it. It's ongoing. It's definitely ongoing. Don't get me wrong. It's an ongoing process of how do we value this so that it's more palatable even for the private equity market, and how do we develop the terms around these deals so that it's more palatable in the later stages. How do we structure them now for success at exit? So those are ongoing conversations we have. And yeah, I must say we've bedded down, I think, what is a cool way of looking at it and approach to it that balances both perspectives. But I think it's an ongoing process. I don't think that, it will change from deal to deal, because each deal brings their own nuances, particularly in the VC space. It's not as standardized as it is in the private equity space. So yeah, it's about structuring it correctly now so that it gets the point that it's palatable for them. Yeah.
There are very few asset managers that are willing to look earlier stage in the value chain. Typically, the sort of progression is you start an early stage fund, you get a bigger fund, you invest in larger assets, you get a bigger fund, you invest in larger assets, you end up in private equity, you go listed. And that's not just in South Africa. You can look at funds across the world, whether they're evergreen vehicles, whether they're typical VCs. You look at SoftBank and the checks that they're writing. I mean, they're almost they're an underwriter. They're so big nowadays. So it's so refreshing and so helpful to have an example of an asset manager looking earlier stage and actually populating the pipeline for later investment, I presume.
Yes. So that actually, that kind of concept was seeded at the PIC as well. So there was, I've just operated in this environment the majority of my career. That's why it seems a bit more normal to me. But you're right. I mean, a lot of people work from the earlier stages on to the later stages, and now 27-4 is moving kind of from the later stages into the earlier stages. And what I think the motivation behind that is structuring pipeline correctly. And also the opportunity, right? The opportunity in the VC market and the early stage market is rife. There's a lot of opportunity, but whether that gets structured appropriately for the later stage pickup is an entirely different conversation. So, I mean, we had this conversation offline about how to bridge the gap, per se. And I think a lot of that is how these deals are structured and how they are structured for scaling. Because the closer you structure a deal for scaling, the more you're going to have appetite from later stage funders. And so it's been interesting. It really has. Like I said, the process, we're always debating on how to get this right and bed it down, and strike the balance between what is appropriate for an early stage fund, but what is also going to be palatable at exit.
No, it's fascinating. I think also just so good to know that certainly yourself, and I'm sure that there are others in the country, are on par with international leaders doing the same thing, and that we have representation. I think that it's one of the things I wanted to ask, if perhaps before we end the pod, if you had anything particular that you'd like to share with our female listeners, leaders in the space, or possibly considering going into finance or into investment management. If you wanted to say something to them, and then if there's anything else that you'd like to add, anything that I didn't bring up and you wished I'd asked the question.
I think, one of the biggest kind of pieces of advice that I gave my little sister when she was moving into the corporate world, I said, find yourself good mentors. I said to her, there's nothing as important as a good mentor. I myself have 3.
Oh, lovely, yeah.
But they form such an integral part of my decision-making processes on important decisions. They advise me on pretty much all aspects of my life, not only my career, but it's how to also structure my personal life aligned with my career, or how to align my career with my personal life in some instances. So it's so interesting. 2 of them are females and 1 is a male. And between 3 of them, I think I always get to a solid decision, which it always brings this like robustness to my decision-making process on big things. But I gave the advice to my little sister that always choose, if it comes down to the choice about money or mentorship and learning, always choose mentorship and learning. An opportunity that offers you that is way more valuable than an opportunity that offers you more money. Because especially when you're early on in your career. And I mean, I'm like a good couple of years beyond a decade. I'm not going to give away my age, but into my career. And I still think that it's not, I still feel like I'm early in my career when I consider like the level of mentorship I need. And I imagine that'll continue. I don't imagine that I would ever do without it, because it's just been so critical in how I've made my decisions.
Oh, that's fantastic, Tishanya. How can listeners get hold of you? They want to find out more about yourself or possibly your fund. Where should they go?
The easiest way is LinkedIn. Just add me and chat to me. I try my best to respond. So I think LinkedIn is the easiest way. And it's also just super easy to find me. So, yeah.
Perfect. I'm sure there'll be a few people looking for you after this. Thank you so much for spending time with us.
No problem. Thank you very much for having me.
Great.
Thank you for listening to this episode of Shapers, Makers, Builders and Breakers. We trust that you've been encouraged by what you've just heard. Subscribe to future episodes and find out more about us at shaperspodcast.co.za. That is shaperspodcast.co.za.
Well, that's right. Don't forget to subscribe for new episodes and other content. And remember, share any feedback with us. We'd love to hear from you. Find me on Twitter at b_d_shaw or via email. We look forward to your company the next time on Shapers, Makers, Builders and Breakers. Until that time, cheers, bye-bye.